What are 5 basic principles to technical analysis? Technical analysis is based on major principle trend. The one constant about the markets is that they trend. Traders and investors hope to buy a security at the beginning of an uptrend at a low price, ride the trend, and sell the security when the trend ends at a high price. This is always easier said than done. Within that major principle, you can see that there are a couple of other principles which will support and validate that major principle. The first principle of technical analysis is that the interaction of supply and demand determine price. It's not some fundamental analysis. It's not some analyst's forecasting. You can bet that it is certainly not the government. Nope, in fact you can bet that it is the simple economic basis of every good and service known to man. That's right, price is determined by those eager to buy and those willing to sell. The second principle of technical analysis is that the supply and demand are affected by investors' emotions, particularly fear and greed. You can't think of any factor you want. Write a list and check it twice. Then it is probably a high probability that any idea you think of can be categorized or be linked with fear and greed. These are the two most basic emotions in the market. The greed of the bulls plays out in their anticipation for prices to go higher. The fear of the bulls is characterized by the potential for prices to move lower. On the other side of this is the fear of the bears that prices will go higher and the greed of the bears hoping that prices will go lower. The third principle of technical analysis is that prices discount everything. What does that mean? Well, to summarize, basically all the necessary factors which could possibly influence prices are reflected in the price of the financial instrument being traded. That is to say that the prices themselves are a reflection of all the possible factors and variables combined at any given moment. It is because of this principle that professionals say that price should be the sole basis for analysis. The fourth principle of technical analysis is that prices trend. Technicians like to say that the trend is your friend until there is no trend. The beauty about the market is that it allows for those who study it enough to make money because of this simple principle. It is a result of one side of the market taking force. When the intensity of the buyers overcomes the sellers, you can anticipate the price going higher. When the intensity of the sellers overcomes the buyers, you can anticipate the price going lower. The fifth principle of technical analysis is that recognizable patterns form with trend. With that in mind, you can conclude that the trend is made up of smaller trends. In a sense, all price patterns are fractal in nature. So when you sit there and anticipate a move on a higher time frame, it is important to drill down to a lower time frame and wait for the lower time frames to start to develop price patterns to support the major trend. To finish, it is important to know that these 5 principles do not cover every aspect of technical analysis. There are plenty of them to consider when trading. These will get you started, and can be used. It is important to learn more